Today, we aren't talking about get-rich-quick schemes. We are talking about hard data and two very different paths to wealth. If you had $150,000 sitting in your bank account today, the choices you make in the next 15 minutes will define your absolute freedom for the next 15 years. This is the story of Leo and Mia. Leo decided to invest his capital into a tangible asset, a franchise convenience store. He wanted control. He wanted a proven system. He wanted a physical business he could touch, a door he could unlock, and a sign with his name on it. Mia chose a completely different path. She decided to build an invisible money machine, a portfolio of high-quality dividend stocks focusing on long-term compounding and absolute passive income. The year is 2009. We are going to track their journey over 15 years of brutal market cycles, economic shifts, inflation spikes, and personal sacrifices. Who will achieve true financial independence? The active operator or the passive investor? Today, we peel back the layers of these two popular strategies to reveal a truth that most business brokers and franchise salesmen will never tell you. Because it is not just about the final number on your balance sheet. It is about the cost of getting there in terms of your time, your physical health, and your mental bandwidth. Both started with the exact same capital, but 15 years later, their lives look drastically different. This is the reality of your investment choices. This is Money Mind Matters. I'm Andrew, and we're going deep.
Leo's journey starts with the franchise. He thinks he bought a business, but he quickly realizes he might have just bought himself a very demanding and very expensive job. Let's look at day one. Leo's $150,000 sounds like a lot of money, but in the US franchise market, it's just the entry fee. Before he even opens the doors, a massive chunk of his capital vanishes. Where does it go? A $50,000 franchise fee, just for the right to use the corporate logo. Then come the legal costs, the permits, the lease deposits. But here is the darkest secret of the franchise model. Leo's $150,000 isn't enough to build the store. The franchisor requires him to build to their exact expensive specifications. So, Leo goes to the bank. He takes out an SBA 7A loan for another $350,000. Leo doesn't just own a business anymore. He owns a $500,000 debt obligation. And to get that loan, he had to sign a personal guarantee. If the business fails, the bank can take his house. The psychological weight of that signature changes a man. The brand gives him a blueprint for success, but he must follow every rule. He cannot choose his suppliers. He cannot change the pricing strategy. He is a glorified middle manager taking on all the financial risk of an owner. And then there is the royalty tax. Every single month, regardless of whether Leo made a profit or took a loss, he must pay 6 to 8% of his gross sales back to corporate, plus another 3% for the National Marketing Fund. The margin for error is razor thin. Data shows that most successful retail franchises net between 10 and 15%. That's a stable income if you provide constant, grueling supervision.
Now, let's look at Mia. Her strategy is the complete opposite of Leo's. She values her time and her peace of mind above ego. She takes her $150,000 and allocates it into a diversified portfolio. But she doesn't just buy random stocks. She focuses on dividend aristocrats. For those who don't know, in the US market, a dividend aristocrat is a company in the S&P 500 that has not only paid but increased its base dividend payout for 25 consecutive years. Think about that. Through the dot-com crash, through the '08 financial crisis, these companies kept raising their payouts.
Mia isn't buying a store. She is buying pieces of the world's most powerful economic engines. And here is the magic trick. Mia doesn't spend her dividends. She uses a DRIP, a dividend reinvestment plan. Every time a dividend hits her account, the brokerage automatically uses that cash to buy fractional shares of the same stock. Each quarter, her money-making machine grows slightly larger without her lifting a single finger. This is the classic snowball effect. In the early years, the growth seems agonizingly slow, almost boring. While Leo is posting photos of his grand opening on social media, Mia's brokerage account looks like it's barely moving. But beneath the surface, the math is working. Mia has no employees to manage, no inventory to count, no broken refrigeration units to fix at midnight. Her only job is to stay patient and do absolutely nothing.
To truly understand the difference between these two investments, you don't look at a spreadsheet. You look at their calendars. Let's look at a typical Saturday morning, 5 years into their journey. It's 6 a.m. Leo's phone rings. His shift manager called in sick. Again. Leo has to cancel his weekend plans with his family, put on his uniform, and drive to the store. He spends his Saturday dealing with angry customers, a broken point of sale system, and a delayed delivery truck. He is earning cash flow, yes, but his hourly rate, when you factor in the overtime, it's barely above minimum wage. Now, look at Mia's Saturday. It's 8 a.m. She wakes up without an alarm. She pours a cup of coffee. She checks her phone, not for emergencies, but to see a push notification from her brokerage. Her quarterly dividend from Johnson & Johnson just cleared. $700 deposited directly into her account while she was sleeping. She spends her Saturday hiking, reading, and investing in her health. This is what the financial industry calls the opportunity cost of time. Leo is trading his life energy for dollars. Mia is using her capital to buy back her life energy.
Then comes the ultimate stress test. A recession hits. Inflation spikes to 8%. For Leo, this is a nightmare. His fixed costs, rent, insurance, loan payments, remain the same, but his cost of goods skyrockets. If he raises his prices too much, he loses his local customers. To keep the lights on, Leo stops taking a salary. He is now working 70 hours a week for free, just to protect his asset from the bank. Now, look at Mia. The stock market plunges 30%. On paper, it looks ugly. But because she invested in blue-chip, cash-flowing companies, the dividends don't stop. In fact, because the stock prices are down, her automated drip system is now buying more shares at a massive discount. And when inflation hits, Mia doesn't have to manage margins. Companies like Procter & Gamble or Coca-Cola simply pass the cost on to the consumer. Their profits rise, and Mia's dividend checks grow automatically to match inflation. And we cannot ignore the billionaire's math. Taxes. Leo is earning active business income. In the United States, that is taxed at the absolute highest rates. He's paying federal income taxes, state taxes, and a massive 15.3% self-employment tax. He's fighting to keep 60 cents of every dollar he earns. Mia enjoys a structural legal advantage. Her income comes from qualified dividends. The U.S. government taxes this at a significantly lower rate. Depending on her total income, she is paying 15% or sometimes exactly 0% in federal taxes on those dividends. She is keeping almost every dollar she makes.
15 years of discipline and chaos have passed. Now, let's bring Leo and Mia back together for the final verdict. Let's look at the exit strategy. Leo is exhausted. He wants out. But you cannot simply quit a franchise. He has to hire a business broker. He has to open his books to strangers.
He has to wait 6 to 12 months to find a qualified buyer, and then hope the franchisor approves them. His wealth is entirely illiquid. Mia? If she wants to cash out, she opens an app, clicks sell, and the millions of dollars are in her checking account in 2 business days. Absolute liquidity. The final results are in. After 15 years, Leo's business is valued at $1.2 million. Mia's portfolio, purely through compounding and dividend growth, is worth $1.1 million. At first glance, Leo won. He has $100,000 more in total net worth. But we must look at the time-adjusted return. Leo worked over 40,000 hours inside that store to earn that extra $100,000. Mia worked less than 500 hours total over 15 years, mostly just reading annual reports. When you calculate the hourly wage of their wealth creation, Mia is the clear, undisputed winner. She achieved the ultimate goal of the sovereign personal fund, the complete decoupling of time and money.
The data doesn't lie, but it doesn't tell the whole story either. Your personality, your DNA, is the final piece of the puzzle. Leo's success is a testament to the builder mentality. If you thrive on chaos, if you love managing people, and you want to control your environment through sheer sweat equity, then the franchise path is a powerful wealth builder. You are creating jobs. You are serving your community. But you must understand the price. You are buying a high-paying job that you cannot easily quit. Mia's success is a testament to systems. She didn't build a business, she built a life. If your goal is absolute freedom, if you value your time above your ego, if you want the ability to travel the world, read, and exist without a pager going off, then dividend investing is your ultimate weapon. Sustainable wealth isn't just about how much money you have in the bank. It is about how many choices you have on a Monday morning. Do you want to be the mechanic who constantly fixes the engine? Or do you want to be the investor who owns the factory?
Most people chase the high returns of an active business without realizing the toll it takes on their soul. Don't fall into the trap of owning an asset that actually owns you. Choose the investment that aligns with the lifestyle you actually want to live. Know yourself before you pick your weapon. Wealth is a marathon, and the best strategy is the one you can stick with for 20 years. I'm Andrew. This is Money Mind Matters. If you're ready to reclaim your time and build your own sovereign personal fund, hit the subscribe button and let's build it together. Build your wealth, protect your time, and choose your path wisely. Your future self is counting on the decisions you make today. I'll see you in the next analysis.